Pretty soon, housing prices are going to go down. Pretty soon, banks are going to stop lending. These are just places where money is that you can use to take advantage of more opportunities than just buying into the stock market.
There's a lot of different options out there with your qualified funds, with your retirement dollars. It's amazing, especially right now with what we're looking at with the stock market and everything going on in the economy.
What's going on, everybody? Week number 2, March Money Madness. I couldn't hit a three-point shot if I tried, but if I could, this is where I'd be to learn. But you see, we're not shooting hoops. We're shooting for money. That's what we're doing. We're trying to learn the truth about money on this 4-week special. This special programming we're doing where every single week we've got a different topic, all relative to what's going on. And today is super relative to what all of you have going on. I mean, hey, listen, not to kind of hit below the belt a little bit, but has anyone been watching the markets? Steven, where are we at today? Futures were up.
It's backing down. The Dow's still down a little bit, but kind of just hovering right now.
All right, but all of you, yeah. So Marie said, yes, a nightmare. Well, the nightmare hasn't even started. That's the bad news. So Here, I'm not going to go deep into the markets. I got plenty of YouTube videos that all talk about the markets and where they're at and what's about to happen. But I mean, I think you've already heard it. This administration has told you where we're going. Every single economist is telling you where we're going, and that ain't a good place, right? So you got to get used to where we're going so that you can prepare for it. And if we're headed to a recession, which is the most probable likely outcome over, the course of this year into 2026, wouldn't it be cool to be ready for it? Like, hey, listen, you're going to a party and you don't know anything about the party, but you want to prepare. What would you do? You'd get educated on what's the party going to be about. Is it going to be like a disco, or are they just going to kind of just be free flowing? Is there going to be a pool? Like, anyone ever show up to a party that's a pool party, but you forgot to bring your jam or your swimming trunks? Yeah. So what do? You jump in naked, wear your boxers, your skivvies, your underwear. It's not comfortable. I'm just saying, I'm trying to get you ready for what's coming. I'm not trying to be a fear monger or try to tell you like, hey, it's all going to fall apart and you're all screwed. But, well, what I'm trying to tell you is if you get ready, if you pick up what we're putting down, and I'm going to put some good stuff down, here's the best outcome. Think about it this way, right? Like, let me just come over here. I just want to kind of show you. If you knew this is what it was going to look like, okay? It's not going to kind of look like this anymore. This is the new starting place. X marks the spot right here. This is where we're going. What does this mean? You could either look at this like the glass is half empty or the glass is half full. It's the only way to look at this. Because how I see this is, let's just say these are different levels. This is minus 10%, which we're closing in on, depending on what your stock is. You might already be down. Then 20. Then we're probably likely, we did some numbers today on WTF. I was looking at the support and resistance levels. Like, we definitely have a long way to go down because we went up. That's how fast we went up, and we're going to come down just as fast. So you know what I see here? People look at this, and you're going to look at it like your glass is half full. I lost 10% on my 401k. I lost 20% on my investments. Oh my God, 30% on my investments. But here's how I see it. Walmart just had a rollback for 10% off on everything. Holy cow, Walmart and Target are now on sale, 20% off everything. And that sale is going to continue until we don't know when. Whoa, all the grocery stores just went 30% off. Cars are now 40% off. Real estate's 40% off. You can buy Apple stock 30, 40% off. But wait, there's more. Do you see what I'm saying? That's the glass is half full. It just depends on how you look at things. But in order for this to get you excited, you'd have to be ready to take advantage of that. So I'm going to start with a story. And there's this guy that I knew, and he was sitting on a gold mine. Okay. And I'm going back some time, so I'm going to miss some details here, but this is pre-2008. I knew this gentleman, and I knew his business he was in, and he had literally massive potential. But I also knew that he was making, he was investing heavily. Like, he took the money he made in his business and he was investing heavily. But the one other thing that he had going on for him is he had this other company he was looking at buying. And I can't give too much away because some of you would know exactly who this person is, and I'm not trying to rehash this. But He had this big opportunity to buy out one of his competitors. This is right before the Great Recession hit. He was leveraged. He had all of his money invested. He kept investing. And listen, I was a financial advisor, so I knew what he was doing. He wasn't my client. I want to preface that. He was not my client. Even if he was, I still would have probably done the wrong things because none of us were ready. When the Great Recession hit, it took him down. He lost everything, including his house, okay? He lost everything because he didn't see the signs. He wasn't prepared for it. And this investment, let's just say he was. Let's say he kind of saw something. He saw it coming. He got out. He got liquid. And then the market went down. He probably could have bought that other business hugely on sale. I don't know for how much. I didn't really pay attention to it after that. But he wasn't able to take advantage of that opportunity, which would have made him a multi-millionaire. He was already a millionaire, but he would have been a millionaire time and time over again if he was able to do that. But let's go to another one. Let's talk about some things that maybe some of you remember. Actually, real quick, all the folks that are on here, we got Jeremy and Jamie, Felix, Linda. How many of you are old enough to remember 2008 and the financial impact that had? Put I in the chat. Now, I know some of you are like, well, duh, we all should remember that. You're wrong. And I don't know what the number is now, but let's just say if you're 35 or up to, I think 38 now, if you're 38 years old or younger, you don't remember the impact of the Great Recession. I think that's the number. Isn't that crazy? Like someone you know that is like in their 30s had zero remembrance of 2008's Great Recession because they were too young to feel the financial impact. Their parents did. So many of you are the parents. But so Amy said, but young and it didn't impact me. So there we go. Exactly. So how many of you are like in your 30s? Put 30 in the chat. So Sam said, I lost my job. Frank, said, I do. So a lot of stories. That's pretty vivid, right? 2008, that was a long time ago. Oh, kind of a real long time ago, but yet we still remember it like it was yesterday. We can still feel the pain that came from that. But here's the other thing. Here's the other thing all of you remember. You remember after the Great Recession kicked in, you absolutely positively remember all of the opportunities that you missed out on. Real estate was probably 30, 40% off, and that would be low. Think about that. Every house that you know about in your neighborhood, let's just pretend that tomorrow they're 40% off. But you kind of know that in the future, 10 years from now, those houses will double in price. Would you not be inclined to want to buy those houses? What if NVIDIA or Apple or any big stock that you know, like, and understand was 30% off or 40% off or 50% off? How many of you would buy? Put buy in the chat. If Apple today was 40% cheaper than it is right now, how many of you would buy Apple? Put buy. Literally, there should be 157 people saying buy. But hold on, let me play devil's advocate. What if you had no money? How would you buy? What if you were broke? How would you buy? The answer is you wouldn't, but you'd want to. So when everything goes down and Apple's 30% off, what do you need? Well, you need some money. You need cash. So today, what we're going to talk about is we're going to talk about two sources of money. I don't remember when it was, 2018, 19, when I wrote the Private Money Guide, my first book I ever wrote. When I wrote that book, I talked about the sources of money. Like, where is money? Where are all the places money is? And, the easiest thing, people are like, well, money's in the bank, okay? Where else is money? Oh, money's in a 401k. Okay. Where else is money? Oh, it's in my IRA. Where else is money? And then you kind of start, some people in this group would be like, oh, it's cash value life insurance. But eventually people would run out of places, which is where that sources of money came in. But what about your current residence? Is there money in the walls of your current residence? We're going to talk about that today. How about your 401k or IRA? Sure, all of you could buy Apple in your IRA, and maybe you could buy a mutual fund in your 401k, but maybe you couldn't. But let's just say your IRA, you could buy Apple, but what if the opportunity was you had a friend that started a company that was going to disrupt the entire industry, and that company's name was Uber. It was a brand new business. You lived next to the founder of Uber, and you knew him, you were friends with him. You grew up with him. And all of a sudden he said, hey, I've got this company, this technology that's going to completely disrupt the taxi industry. Let me tell you about it. Okay, tracking with me? But then they say, I'm looking for partners. I'm looking for investors. Since you're my neighbor, I'd love to have you in. And I think you could help me build this thing. You know, you want to get in on this, like just 50 grand. Just think about that. $50,000. And you could have been let's just say a 25% owner of Uber. And I don't know the numbers if that's correct, but let's just pretend. What would that be worth today? No idea. Probably hundreds of millions of dollars. So can you imagine the return on 50 grand if it turned into a couple $100 million? Not bad, right? But now let's flip that around. That's easy to understand. But now let's pretend that that same neighbor came over and said, hey, 50,000 bucks and you can have into this disrupting company that's going to disrupt the entire taxi industry. We've already got sales. We've already got the technology built. Everything's done. And you say, oh man, I wish I could have. I wish I could. But unfortunately, you know, with this recession, my 401k is down 40%. I got wiped out. My bank account doesn't hardly have any money in it. Oh, and I got my house, but the equity is gone because the house value went down. I can't do it, man. How would you feel today if you were that person? Because you know damn well there was that person. I don't know who that person was. You know that happened. Uber was started right after the Great Recession. That person exists, and they tell that story every day, that regret story. So here's the thing. Before all of this unfolds, before all of this happens, we need to get strategic and we need to get ready for this opportunity. Stop looking at it as the glass is half full and start looking, because let me just stop right there. Let me tell you, I'm not going to use names. The other day, someone came up to me and they said, hey, you know, my family member's 401k is down 100 grand. That's what they told me. To which I replied, I said, so that means they didn't listen to anything that I told them to do. Yeah, I know they didn't. Well, tell them this. Next week, it'll be down another 100,000 and see if they'll make any decisions, but they won't until it is. And that's what happens. People don't make decisions because everybody has this right now. It's different than I've ever seen it. There's this optimism around the market that it's all going to be okay. And it will be okay, but when? Will it be okay in 10 years from now? Will it be okay in 5 years from now? How many opportunities are you willing to lose over the next 5 or 10 years? That's the question you got to start asking yourself. And this is the thing that I have zero tolerance for. I get, excuse my language, I'm going to swear a little bit, but I get these little bitches that comment on my YouTube videos that you know, I'm going to keep putting money in the market because it always goes up. And what I want to say, yeah, it's got to go down before it goes back up. Yeah, but I'm going to keep investing. I'm going to dollar cost average, which I understand. Dollar cost average, you should be. Keep investing on the way down with small amounts. I'm talking about the big amounts that you have in there now. See, here's the thing. The opportunities that you're going to miss during this period of staying invested, during this period of where you're hemorrhaging, plus the headaches and the stress and the family issues that will come out of watching your 401k, watching your IRA completely fall apart because of nothing that you can control. But now let's add some more stress on that, because this is what I want to say to these little bitches. I want to say, yeah, you think you're going to be okay, but what you're going to do is miss out on all the most amazing opportunities of your lifetime. The opportunities that you will talk about until the day you die. The opportunities that you will say, oh yeah, man, I wish I could have, should have, I could have, I would have. Oh, let me tell you the story. I had an opportunity to invest in that Uber company and I would become I would be a billionaire right now. But, so now let's level the playing field, okay? Let's take these stupid lines off the screen. And let's talk about what you should be thinking about, during this whole thing. And I also want to preface something else. For this webinar, this is all educational. This whole March Money Madness is all about education. Okay, so we're going to go until 2:30 Eastern today, and I'm just going to pour into you. I'm going to cover two major topics, two topics where most of all the money is for the middle class and even probably all of us, but I'm going to focus mostly on middle class, and I'm going to show you where all the money is for all these opportunities. But I'm going to also tell you that this rollback, this opportunity has a time limit on it, because it does. There is going to come a time, probably sooner than later, where this opportunity is not going to be an opportunity. You getting ready is not going to be an option anymore because you've already gone past the point of no return. And right now, I know some of you are looking at your retirement account, your 401k, and you're thinking to yourself, you're thinking, oh, it's too late. It is not too late. Please watch the replay of WTF today where I showed the chart. You're just at the beginning. The fireworks haven't even started. Like literally, they launched off a couple starters and you're like, oh my God, did you see those fireworks? They're incredible. I want you to see the grand finale. But you're not going to be able to see it if you don't do it soon. So the only thing we have literally to sell you, and I'm going to just get it right out of the way because, hey, listen, I hate going on a webinar, and I think all of you will agree. I hate going on a webinar where literally you go through this whole thing, and then right at the end, they tell you exactly what the most important thing is and what you want, and then they got this big sales pitch. We're not going to do any big sales pitch, okay? Here's the offer. Okay, I'm going to make it super simple, and I'm going to take 2 seconds, and then we're going to dive in, and we're going to start with IRAs, and we're going to start with retirement accounts. Here it is. So we're doing this for 4 weeks. We are bundling these together in with a bunch of other stuff. First off, 3 books, Private Money Guide, Mapping Out the Millionaire Mystery, and What Would the Rockefellers Do? But we're also layering in what's called the Legacy Builder course. Okay, what this is, if you just imagine having literally the map, all the steps of how to create the family banking system that the Rockefellers used, the trusts, how to create the family trust and all the things around that. That's the Legacy Builder course. It's going to give you all the steps of what you need to do to create your family constitution, to create that structure for your family to mimic, whether, it's a big or small, or it doesn't matter, mimic that strategy that the Rockefellers used. But the most valuable thing that we're going to have in here, because here's all the stuff you're going to get. You're going to get Money School TV. We relaunched this. I don't know how many of you know what it is, but back during the pandemic, we launched Money School TV. We called it MSTV. And literally what it is, it's a combination of lots of videos that we've filmed on all different topics, how to trade options, different stock strategies, some of the stuff we're going to cover today, the infinite banking concept. Matter of fact, it's got the most advanced comprehensive IBC training course ever created. It's 23 hours of infinite banking, organized, put together, and you can pick and choose it. But here's where the real value comes in. You all have watched TV stations, and you flip through and you go to your favorite channel and you watch that programming. And you do that on YouTube too. But what MSTV is going to be is where all of our mentors and all of our experts, from tax strategists to CPAs to oil, investments, to everything that we've ever talked about, those experts are going to come on, and they are basically going to have their own shows in MSTV. We're building it out right now. So literally, you go on and kind of think of the TV guide, if any of you are old enough to remember that, and I know some of you are. You open the TV guide and you find your programming. Oh, that's on Tuesdays at 2 o'clock. Great. You go and you tune in Tuesday at 2, but then one week you're on vacation. You can't tune into your favorite show Tuesday at 2, which is the tax strategy show, for example. So what you do is you just go into MSTV and you go back and you watch the recording. It's like TiVo and all the things today. Sorry, I don't watch much TV. But that's what we're creating. But it's all money, all day, every single day. You're going to have access to all of that. The normal cost for the year is $190 for that. Plus the Legacy Builder course is $97. The books, various prices for books. And we're going to record every week of March Money Madness. You cannot go on YouTube like normal and watch these recordings. They don't exist on YouTube. So to watch a replay of today or last week, which is pretty epic, and the next 2 weeks, the only place you're going to be able to get it is here. So we're going to be putting this up. It's normally $748 is what you'd spend to buy all this independently, but it's going to be $197. That's it. Literally, you're getting almost all of this free, and you're getting MSTV for a year. There you go. I'm done. There's your sales pitch. Thank you. And we're going to move into this. First thing I want to talk about. I want to talk about your retirement accounts. First off, most all of you have a 401k, a 403b, a 457, commonly known as a TSA. I mean, there's all sorts of different names of them, but most of you have some type of a retirement account. Matter of fact, some of you don't just have this retirement account. You have an old retirement account, like an old IRA. You have an old Roth, okay? Or a new Roth, whatever it might be. Or maybe you've just got an old SEP or simple IRA. You've got all these different retirement accounts, which you put money in for your retirement. Let me ask you a question. What can you invest in within your 401k? Anyone put it up there? What is it that you could invest in within your 401k, within your IRA, within your SEP? What is it you can invest in? Put it in the chat. And Coco, yes, there is a way you can talk to a mentor. We'll put up some phone numbers. Actually, Brandy, can you put up your contact info right now? Let's just get that right out of the way. Okay, so Leonard said real estate. And then Kevin said whatever their employer allows. Lynette said stocks and bonds, anything but coins and collectibles. In Canada, it's like, you know, what do you call them? Tax-free savings account. So TFSA, RRSP, I'm forgetting them all. So there's Brandy's number if you want to book a call there. Stocks, target date funds. That's the answer I was looking for. So Boyd said target date funds. Yeah, that's probably the most common thing in the funds that the company allows. So remember how some of those folks said I can invest in real estate? Have you ever do you know that all the money in your retirement accounts, you could invest in real estate? You could invest in, I mean, you could lend money on real estate. So you could become a private lender. So you could private lend. You can invest in companies. So you literally could go to your neighbor who is starting the next Uber and you can invest in their company, all with money from your 401k, money from your IRA, money from your Roth IRA, money from your SEP IRA. However, you cannot do this if your money is with a traditional custodian. Let me mention some of those. Vanguard, traditional. Okay, Fidelity, traditional. Empower, traditional. And I could keep going on. You name it, they're all over here. They do not allow you to invest in all these different things. Okay, how about your 401k? Can you actually go out and buy physical gold or silver? No. But what you could do is you could roll over any old 401ks, old 457s, old 403bs, any old IRAs, SEPs, or Roths. You could roll them over into the exact same thing you had. So it is an IRA. It could be a SEP. It could be a 401k. Okay, and it could be a Roth. The exact same thing. But the difference is this side where you could invest in all this stuff is called self-directed. There is no difference between Vanguard and a company called Horizon Trust, which is a self-directed IRA, with the exception of Vanguard only lets you invest in things that they want you to invest in, things that they can make money on. True or true? Same with Fidelity, same with Empower, same with Charles Schwab, all of them. They'll give you the universe of stocks, bonds, mutual funds, ETFs, all that stuff to invest in, as long as they can make a little something on it. But they can't make anything when you buy a piece of real estate. They can't make anything when you do a private loan through Private Money Club. They can't make anything when you invest in your friend's company. They can't make anything typically when you buy gold or silver unless they're adding on to the spot price. A self-directed IRA custodian cannot give you investment advice. So they can't tell you what to invest in, but what they can do is give you the ability to pretty much invest in just about anything except for collectibles. Typically, a self-directed IRA is going to cost you a lot less than it is to keep your money over here. The only downside for any of you, if you already have an existing 401k that you're still working at the company, or any of these, that you're still working at the company, you more than likely do not have this option unless you get a hold of HR or the 401k company and you ask them about an in-service, non-hardship rollover. I'll repeat that. Stephen, can you put that in the chat? If any of you are over 50 years old, inquire with the company you work for or the 401k provider whether or not they allow for an in-service, which means you're still in service, you're still working there, non-hardship, which means you don't have a hardship, nothing going on wrong in your life, rollover. When I was a financial advisor, a lot of these 401ks, these 401k companies, they would allow that because they didn't want to stand in the way. They didn't care, and they didn't want anyone saying, oh, I lost a bunch of money because you wouldn't let me roll it into a self-directed IRA. So let me ask you this. If the stock market, if you think it's going to go down, do you want to be invested in stocks? Or would you prefer that money that's in your 401k, IRA, SEP, whatever it is, be ready and available to buy real estate when it goes on sale, okay? And also, I'm going to put stocks over here, stocks, ETFs, mutual funds, because they're going to go on sale too. So let's not restrict you to not have those. You certainly can do those, EFTs. So in my self-directed IRA, actually it's my self-directed SEP IRA, I basically created a brokerage account and I bought treasury bonds. which technically would be considered a security. But I also can do private lending from that account. So I can go in private money and private money club, and I can lend money. Okay. And right now, does everybody know what the rate is? Like the average rate in private money club? So I would say right now, and I can show it, 12 to 20% first lien. That's right now the deals we're seeing in private money club. And if you don't believe me, I'm more than happy in a second to show you. Like there are so many deals on private money club that all of you have access to right now. You don't even have to pay to be a member. I mean, if you're a lender and you had a self-directed IRA and you wanted to get in there, let me just show it to you. Just so you don't all think, oh, no way. There's no way your deals are paying 12 to 15. Here we go, 13%. Oh, that's cool. Container builds. Okay, over here, this is Jason. He's got a lot of great deals, and he's building luxury beach homes, 20%. Here's a tax deed, so we'll skip that one. Here's one, okay, just a mobile home, 12%, 12%, 25%, 42 tiny homes. I know Rashad. That's a good deal. You should definitely talk to Rashad. 20%, 14%, 15. There's 10. Okay, that's the lowest I've seen on there in a while. 15, 10, 18, 15, 12, 18. Okay, did I make the point? And I could just keep on going. I mean, 26, 15. So indeed, there are lots of deals between 12 and 20%, but you can't get that over here. And also, when you're doing private lending, is this what private lending, your returns look like? Do they look like that? Nope. You know what private lending returns look like? Kind of like my self-directed IRA balance, that. Instead of what one makes you sleep better at night? Let's label these. Exhibit A or Exhibit B. Put that in the chat. Which one would you sleep better at or better at night knowing? Exhibit A, straight line, or Exhibit B? Because listen, some of you are risk takers. Some of you just love that. But this is for real. Like, you don't have to ride this roller coaster. And you know what else? You can pick and choose when you get on this roller coaster. Because, hey, listen, a lot of people would be like, well, I'd certainly like to ride that roller coaster about right here. Great. In a self-directed IRA, you could have your money. You could be doing private lending. And then all of a sudden, when all this stuff falls apart and you get paid back on a deal, what you do is you take some of it and you just invest it in whatever stocks you know, like, and understand. And then hopefully they don't keep doing this. They kind of do this. I'm just trying to give you some options here. There is no reason why you should restrict yourself from all the things on this side that have a lot of value. Buying real estate during a recession, can't say that's a bad idea. And I think you can talk to a lot of people in 2009, 10, 11, 12 that bought real estate then that still hold it now. You think they're happy about that investment? Oh, yeah. How about the same people that could have bought real estate then and held it that bought stocks then? Do you think they're happy now? Yeah, absolutely. You see, there's really no one that's unhappy when they buy low. People are only unhappy when they buy high and then they got to sell low. That's the only downside. Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris. So what I want to do now, folks, is I want to show all of you something, and this is, I think, the best example that we can give. And I'm going to have Stephen do this. Stephen, you ready to talk about the Bank of C&M Jones? This is going to put some numbers to what we just talked about.
All right, cool. So this is just a real simple and straightforward example of kind of what Chris was just talking about with using real estate to create a simple and predictable income. And actually, Chris, I'm going to share my screen instead. All right, so we'll get this rolling here. So this is, when you're asking about the volatility, I mean, this is all about consistency and predictability. And, it can help you sleep at night, but it also can help you plan. It can help you know exactly what retirement's going to look like. And it kind of gives you goals of what you need to hit to be able to create this income. But real simply speaking, we talk a lot about becoming the bank, and basically we just mimic what the banks do. And if you look at what banks do, they're, as we talked about last week when we were talking about the infinite banking concept and the specially designed whole life policies. I mean, banks are the #1 purchasers of whole life insurance in the entire country because they understand the power of being able to store even their money within these policies. And so we're mimicking what they do. And, banks make money by taking your money. And we talked about this last week as well, and taking that money and moving that money. And by the way, if you missed last week, this is a 4-week series that we have going that started last week. So you're going to want to go back and watch last week. The only way to watch last week's recording is in MSTV though. So make sure you get that, take advantage of that March Money Madness special we're running right now, and go back at some point before next week and watch last week's show, because it's very important you catch that as well so you don't get lost as we move forward through this series. So what we're going to do is we're going to mimic banks. Just like banks, when they take your money in, they don't let that money sit there in a box or in a safe somewhere. They immediately start moving that money, and they do through loans. And one of the primary types of loans that banks do are mortgages. So they loan money on houses. And that's exactly kind of what we're going to be doing here, using our retirement accounts in this scenario. Because remember, a lot of people are putting their money in these whole life policies, but there's a whole trillions of dollars out there that are what are called qualified funds, retirement dollars. And that's the money that's sitting in your IRAs, 401ks, what are called qualified funds. And qualified funds you cannot put into a whole life policy. So there's trillions of dollars out there that we're giving up control. And that's what we're doing, is we're taking back control of that money, those qualified funds, by self-directing. And that's exactly what I'm showing you right here. So just like a bank does, we're just going to mimic what banks do. We're going to become a private lender. That's what they call it when an individual like myself, Chris, Brandy, any of you guys watching decides to lend money on a real estate transaction. We're now private lenders. And this is legal in all 50 states as long as you do it the right way. We have certifications and training in Private Money Club to teach you the right way to do all this. In all 50 states, it's legal except for Colorado. Colorado has some nuances. So if you want to be a lender in Colorado, get with me and I can give you some tips and tricks on getting around that. But it's legal in all the rest of the states, no problem at all. So let me show you kind of what that looks like, creating this predictable and consistent income for the rest of your life. So this is what we call the Bank of C&M Jones, Charles and Mary Jones. This was a real case study. It's probably about a decade old now, maybe a bit longer, but it's just such a simple, great example. We continue to use it. So they were out in Idaho, had a farm. They had been running their farm for many, many years, 55 and 53 years old when we first met them. They had planned on retiring in 10 years. From when we met them at the time, they had $350,000 in their retirement accounts. They were solely focused on their farm and their life. They had no experience managing money or investing or, anything of that nature, probably similar to a lot of you watching right now. And they did not want an active role. They wanted to continue, focusing on what they were good at, which was running their farm and managing their lives. And I'm sure a lot of you guys can are very similar to that. So what they did is they became the bank, and they went out there and they started doing 6 to 18 month mortgages or trust deeds. And basically, again, we'll teach you this in Private Money Club through the certification, the different various webinars that we do. But basically, they're just creating a mortgage to protect their money. And you do so, and creating what's called a promissory note that connects to that mortgage. And in that promissory note, it's going to lay out the terms, so the loan amount, when the money's going to be paid back, what the interest rate is, what the collateral is, and then all that gets attached to the mortgage or deed of trust, and that's the legal document that now protects your money. And the reason you do that is strictly for protection. And meaning, when I lend money to somebody, I need a legal document that says if they don't pay me those terms and pay me my money back, what's the recourse on that? And in this case, with a mortgage and a deed of trust and a PN, the recourse is that property. So we're able to take that property back if that borrower does not fulfill by the terms, just like a bank does. So we're doing the exact same thing. So what did this look like for them? Well, they started with $350,000 in their retirement accounts. What they did is they moved that money over to Horizon Trust, which is the self-directed custodian in this case. When they move that money over to Horizon Trust, keep in mind there was no tax penalties, there was no tax consequences, nothing occurred. They just simply moved the money from, I think it was at Charles Schwab or Ameritrade, one of the two, but they moved that money from wherever their brokerage IRAs were at the time over to Horizon Trust, okay? Now they have control of that money. And what they did is they started lending that money out. Now, because of their situation, and this was a while back when rates were a little bit lower, they decided to lend the people that they were pretty close to, and they gave them a very good rate. So they decided to start lending out at 9%. As Chris said, this day and age, very common, 12, 15, 18%. You'll get on a private money loan. I mean, the last 2 to 3 weeks on Money Club Mondays, we've had deals on there that were at 40% first lien position loans. So you can definitely go a lot higher, but for planning purposes, 12 to 18% is pretty common. But nonetheless, this is a great example because it shows it at 9%. So on top of lending their money each year at 9% for the next 10 years, they also committed to continuing to put money into their IRAs. So at the time, the IRA limits were $6,500 per person. So they each decided to continue contributing $6,500 each into their IRAs. And Brandy can clarify some of the new rules in 2025 and limits and things like that, contribution limits. But C&M Jones, they decided to put $13,000 a year in moving forward. So by taking the $350,000, contributing $13,000 a year for the next 10 years and lending that money at 9% annually, they were able to grow their retirement account to just over $1 million. Now, let me ask all of you this. If you are going to retire and you have $1 million and you are in the same position as Charles and Mary Jones here, what would you do? Meaning, would you take that $1 million and just start spending that money each year? And kind of whittle that $1 million down to nothing? Or if you had been doing it for 10 years, very passively, doing loans to people helping them do more projects and grow their wealth, would you mind continuing to do that in retirement? Most people would be happy to do that. And so what they did is they said, listen, we've grown this nest egg in our retirements of $1 million. Let's just continue doing these private money loans and generate an income for ourselves. So that's exactly what they did is they started lending out just over $1 million a year. And just for this example, it's to say they're doing it 9% each year. Well, what that does is that creates a $92,000 a year annual essential salary for them that they can then live on. Now, most private money loans, again, the terms are fully negotiable, but most people want this. So most loans are like this. The interest, the 9% interest is paid monthly. So if you take the 92,000 they're earning annually at 9%, just over $1 million, break that up, it's about $7,700 a month. And that's without ever touching the principal. So they now know without ever touching their $1 million nest egg in their retirement accounts, they can generate $7,700 a month in income to themselves that they can go out and live on, use for retirement, whatever they want to do with that, without touching the principal. Now, let's say they want to spend a little bit more money. Let's say they want to do something a little bit different in retirement. Maybe, inflation's up. They want to earn more. What would they do? They'll start charging more, right? Instead of 9%, maybe they start charging 12%. Well, what's that same numbers look like at 12%? Well, that's $120,000 a year annually, just over $1 million at 12%, which would generate about $10,000 a month for them coming in. So they can give themselves a nice little raise each month simply by charging a little bit more for the money that they're lending out. So there's all kinds of stuff you can do this. It's very flexible, but more importantly, this entire time, their money was completely protected through the mortgage and promissory notes. So even if things go wrong, they can at least get their money back. So their money was protected the entire 10 years and into the future. They did it very passively. They didn't have any experience. Anybody can learn this stuff. If there's anybody on here listening right now that started doing private money lending for the first time in the last 2 to 3 years because what you learned from us in Private Money Club, put it in the comments. I'd love to hear because I know there's a lot of you on right now that had zero experience and now you guys are doing this and you're rocking and rolling with it. So is that good, Chris? Pretty good example there?
Really good example. I was on mute. Yeah, a lot of questions coming through too. A lot of people are asking how much money is needed to start a self-directed IRA. Realistically, Brandy, correct me if I'm wrong, but you don't need any money to start a self-directed IRA. You just need to be putting money into it. So a lot of times people will start self-directed IRAs and just start dollar cost averaging monthly or however they want to fund it. You can start with $1,000, $500. 500 is probably, I would say, would be the minimum, right?
Definitely.
$500.
Yeah, definitely.
So,
and of course, you have your contribution limits, but we can get on a call and figure that out. But we can start new ones.
awesome. Yeah, so very different than other ones.
And we get that a lot too, Chris. Like, hey, I only got $10,000. Like, I'm not, what kind of real estate am I going to be able to lend on? Like, I can't buy a house for $10,000, so I can't do private money lending. Well, that couldn't be further from the truth. So a lot of borrowers, what they'll do is they'll find, let's say they need to raise $200,000. Well, they might find, 5 or 10 different investors on that one deal that are lending to them. So, and they do it proportionally on the deal. So maybe they get somebody with 10,000, they get somebody with 50,000, they get somebody else with 80,000, somebody with 20,000. So you can have smaller amounts and still lend on these deals. Again, they're fully negotiable and the terms are set by you. So it's just a matter of, what the person that's borrowing needs. Right now also we have, for example, in advertising, you get into private funds. We have a private fund on the site right now that advertises where you can be a non-accredited investor and they have a $10,000 minimum. And I believe that pays 10% annually. So there's a lot of different options out there. And that's everything you can do with your qualified funds, with your retirement dollars, which is it's amazing, especially right now with what we're looking at with the stock market and everything going on in the economy.
One of the questions I just saw, and I'm not quite sure, says, who is bonding insurance for the lender notes? Are you referring to the, I'm not really sure what you mean by lender notes. Stephen, do you understand that question?
I don't know.
We'll come back to that. Can you put that question in the Q&A?
The other thing, Chris, real fast, and we can get to these, I just wanted to mention real quick, because I know there's people that are on right now that are like, hey, I don't have a lot of money to do lending on. Well, keep in mind, you can also use your self-directed IRAs to do active real estate investing. So those of you that have, maybe you're getting into wholesaling. I mean, I don't have an example on a slide right now, but I know Greg talks a lot about this, Brandy, and has a lot of Greg. So Greg Hurley is the owner of Horizon Trust, and so he has a lot of his students and clients and people he works with that are younger. He loves helping younger people, and so they get into wholesaling with their self-directed accounts, and they're turning $5,000 self-directed IRAs into $100,000 plus IRAs in 1 year, because they're just putting that money into wholesale deals you can make $20,000-$30,000 on. So you can use that $5,000 to spin that on wholesale deals and really jumpstart your self-directed IRA. I mean, Peter Thiel, the co-founder of PayPal, he's probably one of the most famous ones. He took a couple $1,000,000 in an IRA and he turned it into billions of dollars by investing self-directed investing Roth IRA into PayPal. And when they sold PayPal, it was worth billions of dollars. And guess what? He made billions of dollars on that deal completely tax-free because he used a Roth IRA. So you really want to eliminate those wealth killers. One of the main wealth killers in this country are taxes. I mean, a Roth IRA is such a beautiful way to do that.
Perfect. I keep muting when you're going, so just trying to keep that going. So, Stephen, if you want to hit some of those questions, we got somebody in there who's got a license to do facials. So if anyone's looking for a facial, Grace has a license, so hit her up, throw a little love her way. But let's see. Yeah. There's questions about IULs. That was all covered last week. So again, grab the bundle. We'll put the link up there again right now. All that information about those are in the March Money Madness bundle. And then there's also a lot of questions coming in about IBC and the policies. That was all last week. We're trying to keep each week really consistent and really focused on the topics of the week. So I'm going to keep going. One other thing too, and I think this is really relevant, and it's missed by a lot of people. Does everybody know what an HSA is? A health savings account. How many of you have an HSA? Put HSA in the chat. It's a health savings account. Basically, I don't remember when it was, but in the 2000s, they came out with this ability for people to put money, tax deductible, into a health savings account that would basically be able to be used to help offset health costs, okay, medical costs. And that was kind of the advent of high deductible health insurance plans, which are just the norm now, right? Most everybody has a health insurance plan. You have some type of a deductible. Now, if it's an HMO or like a PPO, you might have a lower deductible, but a lot of the plans now are like $1,250 and up in terms of a deductible. And again, I used to sell a lot of health insurance. I'm a little out of the know because a lot's changed, but I do know that high deductible health plans are pretty much all most of us can afford. So in doing that, that opens you up. If you've got any type of deductible or high deductible plan, it opens you up to put money into an HSA. So before I learned about self-directed HSAs, I only knew about opening an HSA at a bank. And you know what you got to put the money inside of a bank? A bank account. What did they pay? Pretty much nothing. And then if you had a certain dollar amount in the account, you could then maybe buy mutual funds. But you could do a self-directed HSA. So I'm just going to write self-directed, and Brandy could help you with this. I just opened one of these because ye have very, very little faith in the current medical system. When I was sick, I couldn't even get an appointment with my doctor. They would not see me. And I'm like, what do you mean? Isn't that when you go see your doctor when you're sick? And they wouldn't see me. They literally told me to go get Flonase. I swear to God, that was the doctor's advice. Go get some Flonase. Well, I took that very personal and I said, no more. I found it's basically a doctor that practices different type of medicine, like holistic medicine, lots of other stuff, not getting into that, but they don't accept health insurance, period. It's all self-pay. So I saw this as a huge opportunity. I got a hold of Brandy and I said, hey, Brandy, can I open one of those self-directed HSAs? She said, of course. When do you want to do it? I said, now. So she did it now. And I opened it up. And here's the beauty. So if you're single, you can put $4,150 into the plan. And if you have a family like I do, I can put $8,300 per year tax deductible into this HSA. And then what am I going to use that $8,300 for? Medical. I'm going to use that money to pay for all my medical expenses. And you know what I'm going to do? I'm going to go to my health insurance carrier when it renews, and I'm going to tell them, hey, what is your highest deductible critical care health insurance plan? And I'm hoping that they say, well, we got this one. I don't know if you're going to want it, but it's like $15,000 deductible. I'm like, nope, that's exactly the one I want. Because you know what I'm going to do? I'm going to use the HSA to cover that deductible on my plan. But while I'm doing that, I'm going to be able to get a tax deduction. But here's the fun part. You know what else I'm going to be able to do? I'm going to be able to take the money in my HSA. I'm going to be able to go to Private Money Club and other places and buy gold. I'm going to be able to invest that money in anything I want. Matter of fact, I just Googled this. So let me just share my screen so you all could just do the same thing. I thought this was interesting. Here we go. With a self-directed HSA, you have a broader investment option. Like you can invest in real estate, private equity, precious metals, private lending, notes and mortgages, cryptocurrency. How about that? You get to control, keyword, how to take back control of your money. You get to control over your investments. And the only thing you need to consider are fees. And there are fees. There's fees in almost every investment account, but they are not expensive. I had no problem paying the fees because that's going to save me a ton of money on not having to spend boatloads of cash on premiums to pay for health insurance that doesn't even serve me because they won't even let me see the doc. So I don't know if any of you have that kind of a situation, but if you do, this might be an option. Because I can tell you right now, I'm going to save more than $8,300. You don't even want to know what I'm paying for health insurance right now. But I'm going to save more than that on my health insurance premiums. I'm going to flip that into the HSA. I'm going to get tax deductions, which I greatly are very important to me right now and probably to some of you. So just trying to kind of open this up. A lot of people don't realize this is available. And I know, we don't talk about it enough. I know, Brandy, I don't know how many calls you get on HSAs, but do you want to say anything about HSAs and, how they're kind of rising to popularity as health insurance becomes more and more unaffordable?
They actually are. I would say the last November, December, January, kind of like you, Chris, we just got hit on HSAs. And you're right. I think I seen a question saying that they have a HSA with the company they're with through their job and the amounts are not the same. Completely different. Your company is the one contribution to your HSA. This HSA you will make contributions to. I'm actually helping Shauna right now. With this HSA, all you need is a high deductible plan if you have health insurance or no health insurance at all. So I can get that set up. And Chris is right. With our HSAs, it's self-directed, so you can jump into so many investments with this. Obviously, still use it for health savings if you need it, like Chris is doing, but you can get it invested and built up much faster. This is your contribution limits, and then we can get it invested where you guys can put more money into it as well.
All right, perfect. Thank you, Brandy. All right, so folks, these are just some additional options. And Brandy, there's a question in the Q&A if you want to hit that for Andy. These are just places where money is that you can use to take advantage of more opportunities than just buying into the stock market. That's what I'm trying to do, is open up your thinking and open up your pocketbook, quote unquote, to be able to invest in things outside of just stocks, bonds, mutual funds, and ETFs when this whole event happens. And I think right now it's pretty clear, where we're headed. We are in correction territory. Depending on where the markets go the next couple of days, we could be deep into correction. If any of you remember 08 or you remember the pandemic or you remember 2000, during the dot-com crash, it goes really fast, folks. So I'm just trying to get you ready. March Money Madness wasn't planned to be happening right when the market was starting to shed, all of its gains, but hey, it just happened this way. Now, let me move on from here, and we're going to put Brandy's contact information in the chat. So you guys can all book calls, talk about your, there was questions about 403Bs. Yes, you definitely can roll old 403Bs, TSAs, old 457 government plans. All of those can be rolled into a self-directed IRA. And rolling it over doesn't trigger taxes because it's a qualified rollover. And now I just wanted to open up the HSAs. So Stephen, any questions that we need to address before I move on to the next source of money?
No, I think we're good, but I want to point out it's really difficult to cover all of this stuff in detail and really explain it, in an hour to 90 minutes. And so on MSTV, there are in-depth videos on self-directing, and I believe there's a 5-part series on there. So you can go in and really go in deeper and really learn about this stuff for those of you that are like, oh, it's not enough. And I will also add to that Brandy is very good at connecting with you and talking on the phone or Zoom and ensuring that you're comfortable with everything that's going on with moving the money and what that process looks like and everything else. So at the very least, I would, kind of owe it to yourselves to, connect with Brandy here. And, if you have an existing old 401k or an IRA right now, and explore what that looks like, because it is very, very valuable and it couldn't come at a more important time. So make sure to do that for sure. And what's the best way to schedule a call with you, Brandy? You want to use a calendar or?
Yes, I'm going to put my link and my email down below. That way you guys can just go ahead and copy the link and book with me. Or if you guys want to email me, whatever's best for you guys, I'll put my phone number as well.
Yeah, and go ahead and buy the STV now. It is you get it for a full year. And we are, Chris said at the beginning, we're actively adding a lot of, member only content to MSTV right now. So you're not going to want to miss that, especially with what's going on in 2025 right now.
All right, perfect. So folks, one other question I do want to hit openly, because this is a very important one, is how is there a cutoff to when you can contribute to an HSA? You can contribute to an HSA up to age 65. And that's mostly because after that, you got Medicare available. So 65 is your cutoff. So if anyone's under 65, the HSA is an option. All right, we're going to move on to the next one, and we're going to come back and cover some of this. But the next one I think is really fun to talk about, and this is the equity in your house. This one is the one that is very time sensitive. Because I can tell you one thing, like when we start deflating, when the economy starts going into, we'll just call it deflation, which whether or not that's what they deem it or call it, we're going to see that. We're already seeing it, especially in Florida and other really hot markets. We're seeing pricing on housing coming off of its highs. So I don't know where real estate's going to go. I can't, look into my silver ball or my silver, whatever, or crystal ball is what I was trying to say, and tell you exactly where real estate's going to go. But you better kind of get planning now for this. Now, we're going to talk about hidden equity. How I always like to describe this is it's important that you understand where all your money is. Now, a lot of people exclude the equity in their house, which is kind of like in your walls. When you go home, or if you're at home, look at your wall. Inside of there is a whole bunch of money, and it's just stacked up inside your wall. But it's going to remain there until you get that money out of your wall. Now, please don't go grab the hammer and crowbar and start breaking your walls down and then file a lawsuit against Chris Naugle because he said there's actually money in my walls and I broke all my walls open in my house and there's no money and Chris Naugle is going to pay for it. There is no money in your actual walls. I'm trying to figuratively explain that. So disclaimer, there is no money actually in the rafters of your house. But your house has equity. And your neighbor's house has equity. So all these houses have equity in them because that's just where we're at in the market cycle right now. But the problem is a lot of people don't know how to tackle or access their equity. Now, real quick, just by a show of hands in the audience, how many of you right now have a home equity line of credit? Put I in the chat. And also put down, what is your rate on your home equity line of credit? The average right now is about 8%. How many of you have a home equity line of credit? Okay, so 77585, 3.84. Mine's 3.99, but that's an intro 12-month rate. Okay, but applied for only 30,000, regretting not doing bigger. Okay, yes, 10% interest. Okay, so really what I'm going to do is, a lot of times when people have a home equity, now, how many of you don't have a home equity line of credit and you have a house? Put no. Just put no in the chat if you have a house, but you don't have a home equity line of credit. All right, so I'm going to be speaking to both groups here, but I think for everybody that's putting no, this is going to ring really, really true and be very important to you. a lot of times people with home equity lines of credit will kind of get into this mode where like, oh, the rate's too high, I'm not going to use it. So they just leave the money in the home equity line of credit, which is perfectly fine. But I often find, and I know this is busy here, but I just want to explain this. I just pulled it up just for the sake of pulling it up. Let's just assume that somebody has a home equity line of credit, and I see this all the time, and their home equity line of credit costs 8%. But when I look at their debts, they've got credit cards, they've got car payments, they've got student loans, they've got store credit cards that all average 12.39%. Okay, that's kind of what this shows. So all I did is I averaged all these debts, and they're all 12.39%. Now let's just hypothetically say over here, you had a $100,000 home equity line of credit, and you were using none of it because you don't want to pay the 8%. One of the things you can always do is you could take that 100 grand, pay off all your credit cards and all your debts, take the monthly payment from all those debts and put it back into your home equity line of credit. That right there would give you a spread of 8 minus 12. That's more than you're making in your bank account. Like, why wouldn't you use that? Okay. And here's the other nice thing right now. I can tell you with certainty almost, I can't guarantee it, but I can tell you with certainty, the rate on your home equity line of credit is about to start going down. And actually probably already did. Because as the Fed drops rates, and as we get closer and closer to a recession, the Fed will continue to drop rates trying to stimulate the economy. That's kind of like, they hook you up to the little, I don't know what they call those things. They hit you, boom, what are those called, Stephen? Those paddles they hit you with when you have a heart attack or something and you're dead? What do they call those?
I don't know.
You don't know? Okay, so I'm not the only one, but somebody over here knows what they're called. Those little paddles that you see and like, clear.
Yeah, I think they're called paddles.
They are paddles.
There we go. No, defibrillator. That's what it is. Yeah. So those things, the defibs or defibrillators, okay, those things, that's what the government, or not the government, but the Fed tries to do to the economy, and they do it with interest rates. So when they drop interest rates, guess what happens? We start getting closer and closer to a desired rate, but it doesn't matter. The rate doesn't matter as much as you think, because if over here, you've got a credit card, you're paying 20, and you got a home equity line of credit that costs you 8, who wouldn't do that deal? That's a good spread. But if I average them all out, but here's not the other thing. When you make a credit card payment that you're just paying interest, that money's gone. You don't get it back. You don't get to use it again. When you make a car payment, that money's gone. You don't get to use it again. It's gone. Even if your car payment's low, it doesn't matter. When you have a home equity line of credit and you are putting money back into the home equity line of credit, anything above the 8%, that goes to principal. When you pay back principal, it's kind of like the policy loans that we're always talking about with the IBC stuff. When you put the money back in the policy, the money's there again because you're making principal repayments. So this is just an example. Okay, so I'm going to clear this. Here's how I want you to think about this. Because pretty soon, housing prices are going to go down. Pretty soon, banks are going to stop lending. They're going to start they're not going to have an appetite to do your home equity line of credit. So timing is of the urgent matter right now. I wouldn't even say the essence. It's urgent. During 2008, people's home equity lines of credit that they weren't using got frozen. They got frozen. They couldn't use it. Even though they thought they had $100,000 in equity, because their house decreased in value, the bank has the full right to freeze that money. So the biggest thing that you need to prepare for is to keep that money in motion. I showed you debt, but wouldn't that work if you had a HELOC, on your house, and you could do a deal on Private Money Club at 15%? Let's say your HELOC cost you 10, and this is variable, so it can go down or up, but chances are right now we're on a downward trajectory. Would you do that to make 5%? It depends on the risk on the deal, but that's not a bad spread. Okay, if your rate went down to 5%, guys, anyone remember that? It wasn't too long ago that we could get HELOCs at 5%. How many of you would do that deal? Because now your spread is 15%. The whole idea is this is another pool of money that you have access to today, but you might not have access to in the future. I think every one of you that put no, what you should do is go to your local credit union, your local community bank, and ask them what their rates are on their home equity lines of credit. And I think you should apply for one. It doesn't cost anything. Most HELOCs cost nothing. I think unless it's like I think they call them jumbo HELOCs, where it's like over $1 million, then maybe they make you pay for the appraisal. But outside of that, most HELOCs, they don't charge you for the appraisal. There's no cost for it. It might hit your credit a little bit, but if you get that money opened up and you get that money accessible, you could pay off debts. You could invest that money. You could just leave that money sit for an opportunity that's going to come as things fall apart. It's just another source of money for you to use. But what I wanted to really talk about today is I want to talk about something, but not just talk about it, I want to show it. Because a lot of people don't believe me when I tell them this. And let's start with this. How many of you on here right now have a pretty low interest rate mortgage on your house? Just put your rate. How many of you are proud of your mortgage interest rate because you bought it when rates were really low? What is your interest rate? Just put it down there in the chat. Wow, 2.6. That's good. I'm just seeing if anyone can beat Vonda's here. 2.6. Anyone got better than 2.6? Felix has got 3. That's good. 2.87. Rodney close, but no cigar. So the winning rate right now is 2.6. Okay, Vonda, that's a pretty good rate, right? You would never think of paying that mortgage off, would you? I'm just going to pick on Vonda here. Oh, wait, hold on. What do we got a new winner here? 2.8. Let's see. I think we do. All right, Charles, can I pick on you a little bit, Charles? 2.57. I mean, come on, getting close, but that's the best. So this is Charles. Charles, welcome to March Money Madness. You are now part of the show. Is that all right? All right, so here's what we're going to do. Let me ask you this, Charles. Would you ever consider refinancing your house to a rate of 8%? I mean, would you consider that? Vonda, would you ever do that? Would you refinance your house to 8%? Charles is like, no, you're an idiot, right? You're thinking I'm stupid right now. What if I told you it actually would make sense for you to do that? There's conditions and things you'd have to do, but what if I told you that actually you'd pay a lot less in interest if you were paying 8% and you'd pay a lot less than when you're paying 2.57? What would you say to that? Would you say I'm crazy? He's pursuing that? Okay, Charles said no. So what I did is before we got started, I prepared something here. And I prepared something to show you all some really interesting mathematics, because I'm going to show you exactly that. We're going to do a comparison here, and I'm just going to put this in. Okay, so this is just a calculator. So I'm going to use Charles's numbers here. Okay, 2.57%. So Charles, I don't know what your house mortgage is. It doesn't matter. I'm just going to say 330 grand, 2.57. And it's 360 months left. Okay, we're just going to use those assumptions. So right here, and I love it. So if there's anyone here from Fantastic, this is going to look very familiar. You're going to totally know where I'm going with this. But right here, I use Velocity Banking to pay my bills. I love it. So here would be what this scenario would be. Your payment would only be $1,315 because now 2.57. Let's say you tried doing this today. I think the best rate you can get today is like 5.47. Look at that. See, the payment is much cheaper. So this is a factor. Your payment's going to be cheaper, but you're paying more. So Charles, you think you're actually paying 2.57%, right? Because that's what they told you. That's what some of the marketing materials were. They said that you are paying 2.57. But if you look at any calculator, this is an amortized calculator, okay? Amortization loan. What you will find is you're not paying 2.57. Matter of fact, Charles, you're paying 53.71% by the math. Okay, and these are months, so let's just keep going. Year 2, you're still paying 52. Let's go down to year 7. Now you're paying 46%. These are real numbers, folks. I am not making this up. Year 8, 44. So when do you actually realize that you paid 2.57%? Where is the 30th year? So about right there. Oh yeah, look at that. Surprise, surprise. In order to actually pay 2.57%, I think that was your rate, you would have to pay that mortgage for 30 years. I just showed you the math. You are not paying 2.57%. That is a marketing ploy. That is a 30-year amortized mortgage. So therefore, what it should say in big, bold writing is to get 2.57, you have to pay this thing off. You have to pay it for 30 years. But I mean, hey, you could pay it for 29 years and you'd only pay 5%, not too shabby. Where's 5.7? So you'd have to pay it for 28 years and 8 months to get a 6% rate. There's the math, folks. So I'm just bringing to light what everybody should know, but nobody knows, because they just look at the rate that they were told their mortgage is. Now, don't get me wrong. That rate does play into a very nice low monthly payment. So that's a factor. But when it comes to the volume of interest and it comes down to what you're actually paying, here it is. The average you're going to pay over the course of this period of time, and I don't know what he's got this done, is roughly 43.56 over, I think we did it for the first 10 or 7 years. Why is it that most of the calculations we look at on a mortgage is 7 years? Can anyone tell me why it's 7 years? And I'm going to bring this full circle in a second. You see, banks are really smart. Banks did a lot of research to figure out how long someone actually stays in a house. The average was about 5 to 7 years. That's how long the average family stays in a house, but they might stay there longer than 5 to 7 years. But you see, there's this thing called a short-term debt cycle. And that short-term debt cycle is 5 to 7 years. See the correlation? The average person either stays in their house for 5 to 7 years or refinances their existing mortgage to a lower rate in a period of 5 to 7 years. I think we're going to see a little different this time because people are locked in low, but that's the average. And that ties in with the short-term debt cycle, which is 5 to 7 years. So basically what you're seeing happen, okay, is you're seeing rates go up like they just did, and then you see them come back down during a recessionary period, because usually there's a recession every 7 to 10 years. We're a little past that now, folks. This is the most artificial bubbled economy and artificial bubbled market we've ever had in the United States of America's history. But let's just look at statistics, 5 to 7 years. So therefore, most people will go out and refinance their mortgage or upgrade to a bigger house or a nicer house or a different house in a period of 5 to 7 years, which every time they do that, hold on, let's just look 7 years. Just go 7 years. Here's 7 years. The rate was 46%. When you refinance, even if it's at a lower rate than 2.57, you restart the amortization clock, and now you're giving all your payment to interest. Look at that. Out of a $1,300 payment, $706 goes to interest. That's 53.71, and a lot of them are higher, okay? And 609 goes to principal. That does not flip till usually like around year 10, 6. This was a little earlier because he's got a low rate. But that's all I'm trying to point out, okay? So now what I want to do is I want to flip this. Let's just assume that you went out and you found yourself what's called a first lien HELOC, which is kind of just like a mortgage, but it's in a first lien position. In order for a bank, and not all banks do it, but in order for a bank to do a first lien HELOC, they have to pay off your existing mortgage. So Charles, let's just say you had a mortgage at 2.57 and you decided you wanted one of these first lien HELOCs, but the first lien HELOC was going to be 8%. See, I changed the rate to 8%. Okay, so now you're paying 8%. We're going to keep your monthly payment exactly the same. Okay, which, what was that, $1,357? Let's see if it'll reset. No, it's not going to. All right, let me keep it at $1,826. So Charles, your payment's going to go up a little bit. I could do this so that it's less, but we're just going to keep it at $1,826, okay? Because that's just already built in. How much money are you paying each year here? So this is a simple interest calculator, which basically means the interest is being paid just on the amount of money that's out. So right here, you got 330, same dollar amount. You're paying 8% interest here. So that's the monthly interest charge. And you're paying it down by $1,826. So you started paying 8%, but after the first year, you're really only paying 7.738. Okay. The third year, you're 7.79. And then it just keeps going down. See this? See how it's going down and down? Oh, bye, Mom. My mom came in. You want to say hi to everybody? She's saying hi. So I got something wrong here with the number, but normally, because we're paying this down, but you see I'm missing a couple here. I did this really quick. You're paying it down, but even though it's not, the calculator is not working for some reason, I need Craig on here to tell me what's going on. Probably because I'm paying more in interest. I'd have to figure out the payment. But let's just say here, you were to make an extra payment on this thing. And if you made an extra payment of, I don't know, let's just say in the first year, you doubled it. You paid $3,000. I just want to show you what happens here. And also too, with this one, every time you make a payment over, come on, bugger. Craig does this so much better than I do. Here, let's do it this way. Steven, you guys, I should leave tech to everybody else. If you make extra payments toward this, the rate would come down even more because you're paying principal down. And that way, even though you're paying a higher interest rate, you're paying a higher interest rate on a declining balance. I'm not doing this as good as I thought I was going to with this to show it, but this is going to work out where you pay a heck of a lot less in interest. The only factor we got to factor is what is that payment that you're going to make? Now, I know if you make extra payments on your mortgage, that also makes a difference. And I think we can build that in. So let's just say we paid $3,000 here. Let's see what kind of impact that has on your overall. The reason I'm doing this is I'm just trying to show you that a lot of times we put too much emphasis on interest rates. So we can see now we're still in the 20% range, even though we're making more than double payments, okay? So here's the idea that I'm trying to get at. The idea is a first lien HELOC or even a HELOC works on simple interest. So you're only paying interest on the amount left, the amount of the balance left. So if you were to get a HELOC or a first lien HELOC and you had equity in your house, you could deploy that equity like we were talking before. So if Charles went to a first lien HELOC, and I'm telling you this, folks, we don't sell first lien HELOCs. This isn't something we do. I'm just telling you, my house, my mortgage, I went from a very low interest rate, okay, very low interest rate mortgage into a first lien HELOC. Now, granted, I got a 3.99% intro rate, but after that, it'll reset probably 7%. But what I'm doing now is I'm using that HELOC money out here to make more money. Now, I could use that in real estate. I'm not using it all right now. I could use it for real estate. I could use it to put money in my foundation, which I did, which got me a tremendous savings on my taxes. This is the one thing that we did do with the money that we got from our first lien HELOC. I could invest this money any which way I want. And the only rule of thumb that you'd want to consider is if it cost you 7, you need it to work over here at a higher rate than 7. See, in your mortgage, your primary mortgage, when you make your payments, you can't use that money. It's still locked in the walls. When you use a first lien HELOC or a home equity line of credit, as you're repaying it, when that money goes out to pay off credit cards, to pay off debt, to buy real estate, to buy stock, whatever it is, okay? Whatever that is, whatever the amount that makes, if you put it back over here, that money's now available, anything above and beyond the interest rate. So this literally is a brand new source of money that all of you have, and all of you should run the math. And I promise I should have had Craig on. Craig's really sick. Otherwise, he would have been operating that calculator and wowed you. All I did is probably confuse you with it. So I apologize for that, but I don't know. It's his calculator, not me. He's good in the sheets, and well, I'm not. And I mean the Excel sheets, So
Whoa.
Nonetheless,
March Money Madness, baby, in full effect.
March Money Madness. We got folks talking about being good in the sheets. Google Sheets, folks. Get your head out of the gutter. All right, Stephen, what are your thoughts? Do we have any questions on that? I kind of saw that in my mind as being a little bit better than how I did it there. Just the numbers I was playing with earlier really worked out well, but then all of a sudden I had to switch it up to a 2.57%. What are your thoughts?
No, I mean, it's all incredible stuff. I mean, looking at leveraging, I know you talked about this, but just, looking at leveraging, equity in a home and using that to make a spread. I mean, that's another huge advantage of real estate investing and what we do, especially with private lending, because, if you take the equity in your home and you put it into the stock market, you still are, having to pay that HELOC or pay that higher mortgage or pay that money, and you don't have any money coming in because the entire stock market operates off of putting money in and waiting for growth. Where with real estate, we can put money into a property, we can physically drive the value of that property up through forced appreciation, through rehab and things of that nature. We can do a private money loan where we have interest coming in each month. So if we lend money at 15%, we're paying 8% on a HELOC, we're making a 7% spread. So we have enough money coming in to pay the HELOC, extra amount, plus have extra money for us. And so there's just so many advantages to what they call alternative investing, in this case, specifically real estate investing. And it's just something that I feel like just everybody should at least have some knowledge of, and at least some of their portfolio out there working and doing, if not like you and me, all of it. I mean, at this point, I don't have anything in stock. So just something that I think is so important right now. And, I had a couple people asking about, how they would run the numbers for a first lien HELOC or what that looks like. I don't know if we want to connect them with Joe or connect them with Anthony or
Anthony, I would think would be the best.
Okay.
Yeah. So if anyone's asking about that, I mean, I'm not the expert in that, but we have 2 people on our team that are absolutely freaking wizards with this stuff. So I would give it to them. See, now I'm going back and I'm changing my numbers here. Now they're working because I went to what the average rate was. One of the other things somebody said, Michael, Michael Maxwell said, things are changing, almost HELOC. Only a year left. Do I pursue a new HELOC? The answer I would say, Michael, is yes, because here's why. Not because rates are changing, not because your HELOC currently isn't good and you should just let it ride its course, but in a year, we don't know what things are going to look like. We don't even know if your house is going to be worth what it's worth today, and we definitely don't know if banks are going to be even lending. During the pandemic and during 2008, the Great Recession, several banks went public saying they have stopped issuing home equity lines of credit because it's just too risky for them to do when they just don't know what the price of the house is going to be worth. Plus, if it's a regular HELOC, not a first lien, the bank's in second position. So they hold a lot of risk if housing prices drop. So there's a lot of calculations, but I would definitely say, Michael, now would be the time to pursue looking for that. I always tell everybody, start with credit unions. Credit unions are just far better to work with than traditional banks. You could also go to community banks, but community banks have not been the same since all those banks went under. Republic Bank, Silicon Valley Bank, all those regional banks, quote unquote, community banks went under. They put a lot of regulation and they really squeezed community banks. It's almost like it was a consolidation, trying to get these community banks to kind of sell out to big corporate conglomerate banks. And you saw that happening a lot. But yeah, I would certainly consider getting a new one. Let's see. The other thing too, and I was kind of explaining this on one of the prior slides, is just these are the mathematics behind it. Like if your HELOC's 5, you want to try to figure out what kind of spread you want to make. This is always the most important thing. And I always say one of the easiest, best uses is what Christy from Fantastic teaches is, if you've got a home equity line of credit and you've got debts, this would always be the first place. Do not invest your money from your equity. Do not invest your home equity line of credit or your first lien HELOC if you have debt, because debt is a guaranteed return. Because think about it this way. If you have debts that average 15%, because most credit cards are over 25%, so let's just do 15 as the average. If you've got that, then put your HELOC back to 8. This is always the best place because you can use the money from the HELOC and you can basically pay off the debt, take the monthly payment you were paying on the debt, which is often quite a bit, call it $1,500 in this example, and then roll that back to the HELOC. Because you're losing a bunch of money every single month in interest that you don't have to be. So that's always the best. Then let this recycling recapture pay back your HELOC, and then you can keep using it. So once that's done and your debts are paid off, then you can redeploy it and you can go out there and you can look at private lending, you can look at investing, you can look at all these different things to do, but just don't, a lot of people, I call it the shiny object syndrome. They're always out there searching for the best return. And it scares me. I see it happen over and over and over again. Now I know, the rate determined, the rate, higher the rate, the better, right? But I always say, is the juice worth the squeeze? Actually, I don't say that. Brent Kessler says that. I just copied him. Is the juice worth the squeeze? Is the risk worth the reward? There are investments out there that I've heard of that pay like 40%. I wouldn't put a penny in that investment. Okay, I wouldn't, because to me, after doing the due diligence, it just has too much risk. So I would prefer to do something at a lower rate that has less risk with security versus chasing a return. Because think about this, the worst possible outcome is you got money in your HELOC, you invest that money, you solely invest it to get the highest rate, you find a deal for 40%, and then something happens when the economy switches and now all of a sudden you're not getting your money back. That's like the worst possible thing that can happen. So all I ever say is don't shop rate, shop security. And how you do that, if you're doing private lending, I always say first lien. This is all I lend on. I know there's second and all that stuff, like the sub 2 stuff, but I'm sorry, I'm just all about first lien because I like being in first position, because then I can look at this asset is what's securing my money. So even if I lent money from a HELOC, that's my house. My family lives there. My daughter lives there. My kiddies live there. Like, I don't want to jeopardize that. So if I lend money from my house and something happens and this person stops paying me, I can go into foreclosure and I know that this house has a higher value than what I lent on. And I used to lend at 80%. I've moved down. Now I'm like 60%. I don't want to lend any more than 60% of the value of the house. And you can value it, there's LTV or ARV. ARV is probably fine as long as you control the rehab money. So that's how you control risk. because the risk really is mitigated because you've got a tangible collateralized asset backing your investment. But again, although all this is important, we teach all that in Private Money Club and the Accelerator, and we're going to be talking about that at the Private Money Club Money Tank event. You don't do that until we've taken care of the debts. I've got a unique case study I'm going to be showing, and I'll do it one of these weeks, probably not in March Money Madness, but I'll do it in one of these weeks where I'm going to show a real case study of what I'm working on right now. It's an awesome case. It really is. It's a beautiful family, great people. They've got policies that they didn't know they could take cash value, old whole life policies that they can take cash value. They've got equity in their house. They've got 401s that they can take loans from. And that was all on one side while they accumulated debt on the other. And what I showed them is I said, listen, like, let's just move the money from the left side to the right side and then move the money from the right side back to the left side in monthly installments. Dollar for dollar, nothing changes. It's no more than what you're paying now, except for you get to keep all the money. Literally, think about that. If all of your monthly payments on your debts, if you could change the name on the check to just be your name instead of whatever name you pay to every month, would you do that? That's what I showed them how to do. Literally, I showed them how to use assets that they didn't even know they could use the money and redeploy them out to pay off debts and then make the payment from the debts they were making to somebody else back to themselves and keep the money within their policies and their 401k. And I said to him, she kept saying to me, so, did you wait? Are you going to set a policy up for us? Are you going to do this? I said, no, we don't need to. You already have policies. In the future, we'll probably do additional ones, but like, I'm not trying to sell her anything. There's nothing for me to sell her. She can solve her problem with exactly what she's got, but she never would have solved her problem. She never would have solved her family's problem if I didn't show her the way. And I often forget that. I often I just forget that is something that a lot of people don't realize. Let's just move money, and whether it's a HELOC, but let's just show people how to solve their problem with what they have now, and then we can build on that. So folks, today, what we covered is we covered two things. We covered your retirement dollars. There is a ton of money sitting in retirement accounts, 401ks, 403bs, IRAs, and all those qualified retirement plans that most people don't think they can invest in these fun things like private lending or real estate. That money's got to stay right where it's at. It's got to be locked up with the traditional investments. And oh my God, I'm losing money in those traditional investments. Get off that path. Literally get off that path and walk the path least followed, which is this one. The people that know about self-directed IRAs are far and few, but the ones that do are the ones that are really doing well and will continue to do well into a declining economy. Secondarily, this one's urgent, home equity lines of credit or looking into first lien HELOCs. Get on the phone. When this webinar is done, get on the phone, call around, find out who's offering them, see if there's any intro rates, get that equity locked up. Pay your debt off first, then look for opportunities after that, but don't be in a rush. Don't be in a rush. The markets are going to bring it to you. Just wait for it. If you get a home equity line of credit approved and you don't know what to do with it, you got no debt, just wait. Just wait. And then the entry will present itself. All right, what else we got? What about considering bankruptcy? Does that? Yes, it definitely does. So probably going to be difficult to get a home equity line of credit if you got a bankruptcy, depending on how long ago it was. Yeah, only regret is didn't find this earlier. Carrying debt all my life. Been so busy working, I never knew, because that's the system they plug us into. I mean, by now, Devin, you should probably know that. They want us to work. They want us to work overtime. They want us to make just enough to pay our bills. They want us to use as much credit as we can so that we're always chasing the dream, but never reaching it because we're always giving them all the money. That's why it always says if somebody wins the lottery, all the money makes it back to the same place it came from. It just takes time because we're not taught how money works. This is just 1 week of a 4-week series that teaches you the truth about money, how money really works. Last week was epic. How many of you were here for last week's webinar? Any of you here for that? So Samantha 70, listen, you're never too old or too young to learn this. Absolutely. So the chats have been fantastic, folks. They've been absolutely fantastic. So I don't want to keep anyone much longer because we are at our time. We started 6 minutes late. Now we're finishing right on the hour. Book a call with Brandy. If you've got an old 401k, an old IRA, or you're thinking that maybe an HSA would fit your situation, book a call with Brandy. See what she can help you with. They've done great by me. Steven's had his accounts at Horizon Trust for a while. I think your son even has a Roth, right?
Yeah.
Yeah. His modeling money went into it. But listen, like I have done very well with my self-directed IRAs. My wife just lent money on a real estate deal from her self-directed IRA. It's super fun. And then not only that, our HELOC. So I haven't deployed all the money from the HELOC, but I'm waiting. And I want all of you to be in that boat. I want all of you to be in that boat, just like I started this, where you see the opportunities. And now you've got the source of funds to take advantage of it. For some of us, this will be the first time in our life where we're ready for this. That is my goal, to get you ready for this. All right, so a couple things. Housekeeping. We talked about that bundle offer, okay? Right there. I'm going to put it up in the chat. March Money Madness bundle. You're going to get the books. You're going to get MSTV for 12 months, okay? Where we're going to be doing lots of lives, coaching, all sorts of stuff is in the MSTV, but it's basically everything you should have learned in school that you never learned about money. It's all in there. So get into that. $197, literally a bargain. $197. That's what it's going to cost you. Say more about the little bitches. Sam, you're funny. Well, if any of you really want to see it. So like, I don't really candy coat things. And Steven's always like, you can't say that, but I do. You know, on YouTube, I seriously, like I had a guy, and I'll just riff here real quick, but I had a guy that was commenting on one of my videos, and it was just so idiotic. You know, he's like, so with those policies, you know, in your video, you failed to tell us where the money's going to come from to capitalize the policy. And I should read my comment. It's hilarious. I'm like, you know what? I misjudged some of my audience, and I thought they were way smarter than that. The premium deposits you put in are just like the savings you put in the bank. So obviously they come from your income, but I will make sure just for you, and I remember what I call them, but I call them something. For you, I will make sure to tell you exactly where money should come from that you should already know. I said something like that, but you know, there's just that. And then there's all sorts of people why would you do this? Buy term, invest the difference. You know, they always say that. Well, we did a white paper debunking buy term, invest the difference, mathematically showing you it doesn't work. Okay. It doesn't work the way that they teach it. But yeah, all of those are the little bitches I'm talking about. But with that being said, I don't want to keep you much longer, folks. Thank you so very much for joining us for this episode of March Money Madness. Steven, you got anything you want to say to bring us home besides go little bitches?
I love it, man. Don't be little bitches, and I'll see you guys on MSTV, I guess. That's all I got, man. That's all I got. No, this is great today. This was really good. I really thought it was good, but I'm super stoked for MSTV. I mean, MSTV was the original thing we launched when COVID hit, and we didn't know what else to do because we were supposed to be traveling the country doing live trainings in person. We pivoted, created Money School TV. It was amazing during COVID, helped hundreds of people, if not thousands. At this point, we kind of forgot about it on everything else we've done over the years, and bringing it back right now in 2025 with Money March Madness as the first big launch of it, and just super exciting, man. So thank you all for being here. Thanks for being part of Money School TV, and we can't wait to keep putting all kinds of crazy, valuable content out for all of the members. So appreciate all you guys.
All right, so there they are. If you want to book a call with one of our money mentors to discuss IBC, the infinite banking concept, or anything else that we talked, that link's there. There's your March Money Madness bundle link. If you want to get in on that 197, and right there, Stephen just posted Brandy Dean from Horizon Trust. There's her phone number and her email. With that being said, it's been an honor. It's been an honor to serve all of you on this second week of March Money Madness. We'll be back for a lot more next week. So stay tuned. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.